If you've been watching the news and really quietly wondering, should more of my money be in Canada or is my portfolio actually safe? You're not overreacting. I had a client ask me something like that this week, and he said, do I have any Canadian content in my portfolio? And honestly, I understood the question immediately. When the economy feels uncertain, our brains look for certainty, something familiar, something we can point to. So today, I want to give you a calm, practical way to think about this. And then I want to answer a deeper question. Should your advisor invest like you? Because this week is about one thing, trust, and how it's built long before markets get wobbly. The real question behind, do I have Canadian investments? Well, when someone asks me, do I have Canadian content? The question is usually not about geography. It's about safety. It's about, are we being smart? Are we exposed? Are we missing something? So really, here's the plain language answer. A strong portfolio usually isn't built on one country. It's built on diversification. Diversification just means you don't really rely on one place, one company, or one idea to carry your future. Canada has great companies. The US has great companies. Other parts of the world do too. And different parts of the world lead at different times. So if you're invested only in Canada, you might be taking on more risk than you think, because Canada's market is more concentrated in certain sectors. And if you're invested only in the US, same thing, you're still putting your future in one basket. The goal isn't Canada good or US bad. The goal is a plan that can handle uncertainty without you losing sleep. Here's the sentence that changed the whole meeting. In that meeting, after I explained diversification, I added one sentence. I own the same investments as you. And I immediately saw them relax. Why? Because it really quietly answered the question people are afraid to ask. Are you recommending this because it's right or because it benefits you? Now, let's be very clear. I'm not saying every advisor must own the exact same holdings as every client. People have different timelines, they have different goals, they have different tax situations, and more so, risk tolerance. But what I'm saying is this: you deserve to know your advisor is really aligned with your best interests, not just skilled at sounding confident. Here are 5 signs that your advisor is truly acting in your best interest. 1, they can explain your portfolio in plain language, not because the fund manager says so, not acronyms, plain language. What you own, why you own it, and what it's supposed to do in your plan. Now, if you leave meetings confused, that's not your fault. That's a communication problem. Number 2, they talk about risk like an adult, not fear-based, not hype. They tell you what could go wrong, how your plan accounts for it, and what the plan is when markets get rough. 3, they don't flinch when you ask direct questions. Try these. What would make you change the strategy? How are you paid? What conflicts should I know about? If markets drop 20%, what's your plan? A good advisor welcomes those questions. Number 4, they build a plan, not a product pile. Your investments are one part of your life. A real plan includes cash flow, debt strategy, protection, meaning insurance, taxes, estate basics, and retirement income, even if you're not retiring tomorrow. If every meeting is just buy this, switch that, you may not have planning. You may have transactions. They give you emotional safety, not just numbers. This matters, especially in your 40s and your 50s and beyond, when you might be managing kids, aging parents, job changes, health stuff, all while trying to retire someday. The question isn't only, did we beat the market? It's also, do I feel steadier after I talk to you? 4, the trust question you're allowed to ask. Now, this is the big one, okay? This is a question people worry is rude. Are you doing this too? You can ask it respectfully, something like, help me understand. Do you personally invest in a similar way? I'm not asking for details. I just want to know you believe in the strategy beyond selling it. A strong advisor won't get defensive. They'll explain alignment, and why your plan is built for you. If you're feeling nervous about Canada, here's a calm checklist. If you're in that uncertainty moment right now, here's what to do this week. Step 1, ask for a simple breakdown. Can you show me in a simple way how much is Canada, US, and international? Step 2, ask what each part is doing. What is the Canadian portion meant to do? What is the US portion meant to do? Step 3, confirm your timeline and goals. A portfolio should match when you need the money, not your mood this week. Step 4, get the down 20% plan. If markets drop sharply, what do we do and what do we not do? Step 5, what you need most, clarity or change. A lot of people don't need a new portfolio. They just need a clearer explanation and a steadier process. Now, if there's one thing I want you to take away, it's this. The best portfolios aren't built for certainty. They're built to function through uncertainty. And the best advisor relationships don't rely on fancy language. They rely on trust. And this week is about one thing, trust, and how it's built long before markets get wobbly. If you want to drop a comment, what's the money question you've been afraid to ask your advisor? And if you're watching this thinking, I just want someone to explain things in plain language and build a plan I can actually live with, you can connect with me through the link in the description.